This class we will discuss about the net assets or capital turnover ratio and the gross profit ratio. Net assets or capital turnover ratio shows the relationship between the revenue from operations and the capital employed. Revenue from operations is the revenue or income that we get from the normal operations or the normal activities of the business, that is in making a product and selling the product. Capital employed consists of share capital, reserves and surplus, and the long-term debts of the company. This capital employed turnover ratio, it is again divided into two types, that is fixed assets turnover ratio and the working capital turnover ratio. Fixed assets turnover ratio shows the relationship between the net revenue from operations and the net fixed assets. Working capital turnover ratio can be calculated by dividing the net revenue from operations from working capital. Can go on with one problem. Here a problem is given in the form of a balance sheet from which we have to find the net assets turnover ratio, fixed assets turnover ratio and the working capital turnover ratios. Here revenue from operations given directly, so we no need to find it. Then for finding the net assets turnover ratio, the formula is revenue from operations divided by capital employed. We have to find the capital employed. As I have said, capital employed consists of share capital, reserves and surplus and long-term debts. Surplus means the amount that we get in the profit and loss account or the income and expenditure account. That's a profit. Profit and loss is also included in this category. Then share capital, here preference share capital and equity share capital is given. Then we have to add these two to find the total share capital. It is written in brackets, that's 4 lakhs plus 6 lakhs. Then there is general reserve and balance in the statement of profit and loss, that is the surplus amount it is. So we have to add that to 1 lakh plus 3 lakhs, that is reserves and surplus. Then again the long-term debts, the company's debts, long-term debts, it consists of the debentures and the loan amount, that is 2 lakhs and 2 lakhs. 2 lakhs plus 2 lakhs. The total, when we add this all the things, we get the amount as 18 lakhs. Next we have to find the fixed assets turnover ratio. For finding that one, the formula is net revenue from operations divided by net fixed assets. So we have to find out the fixed assets from this one. Fixed assets consist of plant and machinery, land and building, motor car and furniture. So we have added all the 4 things and the net amount will be 16 lakh. The next thing we have to find the working capital turnover ratio. For that one we have to find the working capital. Working capital means the excess of current assets and current liabilities. Current assets consist of the assets that are used or which are kept by the firm within a one year period. Here it is inventory. Inventory is stock, also known as stock. Stock, debtors, bank and cash. These are the current assets. By adding these 4 values, we get the amount as 4 lakhs. And current liabilities we have to find. Here it is liabilities. Current liabilities means the liabilities which are paid within 1 year. So here it includes creditors, bills payable and outstanding expenses. By adding these 3 values, we get the amount as 2 lakhs. So by reducing current assets minus current liabilities, we get the amount as 2 lakhs. So next we have to apply all the things that we found in the formula. Then net assets turnover ratio is equal to net revenue from operations divided by capital employed. Net revenue from operations, it is already given, that is 30 lakhs. Then the capital employed, we have found it as 18 lakhs. So by dividing this, we can get the we will get the amount as 1.67. The unit is times. Next we have to find the fixed assets turnover ratio. The formula is revenue from operations divided by net fixed assets. So that will be 30 lakhs divided by fixed assets, that is 16 lakhs. Then the amount will be 1.88 unit times working capital turnover ratio, net revenue from operations divided by working capital. So that will be 30 lakhs divided by 2 lakhs. Then we can get the amount as 50 times. Next we will study about the profitability ratios. Profitability ratios are used for finding out the earning capacity of the business. There are 10 types of profitability ratios, that is gross profit ratio, operating ratio, operating profit ratio, net profit ratio, return on investment, or we can say ROI, or return on capital employed, ROCE, return on net worth, RONW, earning per share, book value per share, and dividend payout ratio. Gross profit ratio is equal to gross profit divided by net revenue of operations, net revenue from operations or of operations divided by 100. So we can move out to one problem. Here we have to find the gross profit ratio. Some informations are given. The revenue from operations, here it is given cash and credit. So the net revenue from operations will be we get that one by adding the cash and credit. So net revenue from operations is equal to cash revenue from operations plus credit revenue from operations, that is 25,000 plus 75,000 gives 1 lakh. Then coming into question, here purchases, cash and credit purchase is given. Then any other things related to purchases, we have to check the question. Then return outwards is given. Return outwards means if we have purchased something and we have found it defective, then we are giving it back to the party from whom we purchased. So it is return outwards, going out from the business firm. So it will be reduced from the net purchase amount. So the total purchases or net purchases will be cash purchases plus credit purchases minus return outwards. So that is 15,000 plus 60,000 minus 2,000 gives 73,000. Gross profit ratio, as I have said, gross profit ratio formula is gross profit divided by net revenue of operations divided by 100. So we have to find out the gross profit. Net revenue from operations we have already found. Then for finding the gross profit, the formula is income minus expenses, or revenue from operations minus the cost of revenue from operations. So for finding out the cost of revenue from operations means all the expenses related to the all the expenses related to operations of the business. Then purchases, it is an expense. Then here it is written as decrease in inventory. Decrease in inventory means opening stock or opening inventory minus closing inventory. So we have to add that one. Plus direct expenses. Direct expenses means the expenses that are connected with the daily operations of the business. So that includes carriage inwards. Carriage inwards means the amount or the carriage charges for bringing the goods to the production center for making the final product. Then here there is given salaries. Salaries is not a direct expense, it is an indirect expense, not related to the manufacturing of the product. It is an indirect expense, so it is not to be taken. Then there is wages. Wages is a direct expense. So these all things we have to add the amount. So purchases we have already calculated, the amount is 73,000. Decrease in inventory is 10,000, and the direct expenses, that is carriage inwards and wages, that is 2,000 plus 5,000. Net amount will be 90,000. Then gross profit formula is revenue from operations minus cost of revenue from operations. Revenue from operations we have already found out, 1 lakh it is, minus cost of revenue from operations 90,000. So the net amount will be 10,000. Then applying it in the formula, gross profit ratio is equal to gross profit divided by net revenue from operations divided by 100. So 10,000, gross profit divided by net revenue from operations into 100. So 10,000 divided by 1 lakh into 100, we get it as 10%. It is expressed as percentage. Gross profit ratio is expressed as percentage. That is all for today's class. Thank you.